Should have
All right, we're getting everybody in.
should have got a glass of water.
You need a glass of water? I'll ship you one, but it might take a really long time to get there. Is Robbie close by? You can just kind of bring it. No, nope. Okay.
Robbie, Robbie and Marie both
Did they leave?
tried to make this more of a vacation.
Okay.
I have not set foot on a beach or in the water here
Okay.
in Hawaii, and that's it. That's my own fault. It's entirely my own fault.
Okay. So for those that didn't just hear, Rob is in Hawaii. He normally does like to wear leis to our rundown, but this week he does have a reason for it.
Legitimate. It's a
Really
legitimate
good
thing.
reason. Tell us about the conference. What have been like your big, I don't know, 2, 3 takeaways?
Um, so Mark Jones spoke, chairman of the NBA, and got some time with him and Robbie just to chat about life, being NBA chairman. Uh, the there's a lot going on with these junk fees, and I mentioned it in today's opening paragraph. The this whole junk fees, really appraisal costs and credit report costs, flood surge, are those really junk fees?
Yep.
Rohit, no, they're not. They are required by ability to repay or by investors or whatever. So uh, that's a big topic, and he talked about that yesterday. In general, the feeling out there is there's still overcapacity in our industry, given the how efficiencies have improved, but volumes have dropped, but the staffing has not dropped to the extent that the volumes would dictate, unfortunately. So we still have a little bit of room to go, but the good news is rates have come down a little bit, which is nice to see. The overall mood of the conference here, the people are wonderful. The mood is good. It's like kind of like old home week in terms of people know each other and so forth. So that's nice. And most of lending in Hawaii is done by credit unions and banks, Honolulu Fed or Territorial Savings Bank, whatever it might be. And so it's kind of a different vibe. It's not a banking conference because there are a lot of IMBs and so forth, but the lion's share, I mean, the banks dominate. So, and they have their profit and their loss picture is different than an IMB. IMB, it's mortgage. Banks have, car loans, credit cards, and all kinds of other accounts that can help their P&L. So they're a little more cushioned against the ups and downs that an IMB might feel. But it keeps, no matter where I go, it seems like it keeps coming back to a lack of inventory, and the baby boomers aren't moving. A lot of them aren't downsizing, and so and builders don't seem overly interested in starter homes.
Yeah.
So as I always say, you could give everybody a 0% loan and not care about their credit, but if there are no houses to buy, what difference does 0% make? So
Hawaii
anyway,
has unique challenges with some weather related issues too lately that are affecting their inventory. So yeah, that's interesting.
the
Uh,
a big conversation topic is obviously is the fires on Maui, and you have a situation there where, and we're not sticking to script here much, but it's
all good stuff.
an
Yeah.
interesting topic. The the fires basically wiped out downtown Lahaina, and I've been to Lahaina many times, and it's kind of like an old west town on the coast of Hawaii. And now the question is, like Mick Fleetwood, for example, Fleetwood Mac, Mick Fleetwood owned a saloon there, that kind of thing. And it was that kind of rustic environment. Well, now with it all wiped out, do companies come in and do you try to replicate exactly what was there with all of the lack of zoning that they had building the town initially? Or do you spread the buildings out, in which case you lose the rustic character? Do you use different materials? Where does the wood come from? I mean, they're going to need a lot of wood. They need a lot of labor. Where's all that going to come from? So it's going to take years and years and years to figure out. And meanwhile, between that and the wildfires and the hurricane damage and the flooding, I mean, chunks of housing units continue to get taken out of the housing pool,
Yeah.
and it's not a good situation.
Well, and Hawaii's not alone. Sorry, I couldn't resist. It's, there's a lot of states that are having those similar kind of challenges. California, Louisiana, even in some areas. So Florida. So they're definitely seeing some similar things that other states are going through right now. I know we're going to talk about junk fees, so I want to I wanted to ask you so many questions around that, but I want to pause it just for a moment. Because I want to make sure we at least kick things off, and then I've got a fun trivia question for us to see if we can stump everybody. And I do have some background this week on the answer, so just for everybody's reference. The question that I have for everybody this week is, because we're going to be talking about title insurance a little bit today, when did title insurance originate? Let's see it in the chat. Rob, do you have any guesses? No, I'm boring you with my history, aren't I?
No, I like this guy. I'm just trying to think, title goes back hundreds and hundreds and hundreds of years.
Yeah.
Insurance, not so much. I don't know, 1940. That's just a total dart throw there.
We got lots of answers. 1850, 1868, 1934, 1785. Wow. I mean, we're like all over the map. Yeah. How about TJ? What do you think?
Well, I know that Stewart title insurance is 140 years old. So I can tell you that it's at least that far back. I want to say it's probably the late 1860s. I think the start might have even been California with specialty insurance groups pooling to ensure the risk around claims and gold mines and whatnot. So that's kind of my sense.
I mean, you hit it on the head. 1868. Actually, Gemma got it right too. Yeah, 1868. And the state, I think probably there's some questions about it. I pulled actually the Pennsylvania Supreme Court ruling in 1868 was the first kind of establishment of it. So yeah, we learned something new today. How about that? TJ, awesome. I love it.
Wow.
Yep. Mark, I'm not sure we actually have a prize for this. I might have to come next week with prizes for everybody, but at least we learned something new on a Friday afternoon. And then let's talk about some fun stuff. I'll go ahead and get us kicked off. Happy Friday, everybody. For those of you that I have not met before, my name is Melissa Langdale. I'm the president and COO of the Mortgage Collaborative. We are super excited that you have joined us today. As always, joined by the very flowerful. I don't think that's a word. Is it a word?
Flowerful.
Flowerful. Rob Chrisman. He's not always flowerful, but today he happens to be flowerful because he's in Hawaii, and we're just going to keep going with the word because it sounds right, and he's got the nice lay on. And today's very special guest is TJ Harrington. TJ is the SVP, the National Product and Sales Enablement with Stewart Lender Services. TJ, thanks for joining us today.
I am so happy to be here. Thanks for inviting me.
Yeah, we have some really fun topics in store for everybody today.
So Stewart has been around 140 years.
I think 130 years is the official timing. Yeah, they got started in Texas by the Morris family 130 years ago, and really their bailiwick was oil and gas. That's really the center of the company. but yeah, it's been around that long, and Fidelity traces its roots back into California. And there's other companies that eventually became other companies, First American, obviously, other places like that. So yeah, Stewart's 130 years old and one of the oldest publicly traded companies.
So it is, so I could buy stock in it.
Yep.
How's the stock done?
Well, I call this the TJ Harrington effect, but since I joined the company in October, the stock's up almost 50%.
50%?
Yeah.
It's all for you, TJ.
I would never claim that. I would tell you that Fred, our CEO, is excellent, and he has done a great job educating the street on the Stewart story and how we've changed as a company in the last, particularly like 7-8 years post Fidelity failed merger, where we've arisen like a phoenix and are now much broader and deeper than just title insurance. So we have a number of integrated services, including credit, verifications, appraisal, and technology.
Haven't you found that, sorry to hijack the show here, Melissa. Haven't you found though, so you've been there a short period of time, but as you expand your products, you compete against more companies.
Absolutely. And really for me though, the way we're approaching it and my thought about it is the more we own in the manufacturing process to partner with lenders, the more margin we can spread to decrease costs. So the idea of trying to create a predictable pricing model and having a third-party chain where you have continuity with a publicly traded company with reserves for counterparty risk, and just, giving us appraisal, giving us credit, giving us verifications and title. Now we have an enterprise relationship where now I can steeply discount some of those relationships to where it's a difference maker on a P&L to the tune of, in some cases, particularly credit, millions of dollars in a year. So while I do find myself competing with specialists in the field, the depth and breadth of the Stewart offering, I think, is a compelling story.
Yeah, I know that when I talk to people in their companies and they're saying, oh, we're gonna get into verification and we're gonna open up a credit reporting agency. And, oh, we're gonna, do this and we're gonna do that. And I say, you're just what you're doing. I mean, knock yourself out, but you are competing against companies who have established relationships in those certain industries, just like consulting firms can, I hear somebody will retire. And by the way, Melissa, I just got yet again today another retirement note from somebody who's, Rob, I love your commentary. Been in the business 35 years. Please change my email from this to that, Hotmail. And so anyway, these consulting companies say, oh, we're gonna get into cybersecurity, and we're gonna do this, and we're gonna do that, and this and that and that. You really expose yourself to a lot of competition that you may not want. So that's good that you can, bring your strength to bear on different areas like that.
Yeah, and Rob, part of the statement too is we're buying going concerns and molding and rolling them into the Stewart family. So our credit and verifications is informative research, and they have a fantastic kind of, I call it an orchestration engine. And so buying something like that and adding it in the family and giving it the strength of not just the Stewart brand, but the reserves and financial strength, allowing them to scale and be a better counterparty for someone like a Chase or a Wells Fargo to kind of grow their client base. That's kind of been the strategy. Now, absolutely understand that we're rolling hard against CoreLogic, against ICE, against, now Dark Matter, against all the bureaus. Those are a hard group to fight against, and they're very, very well entrenched, as you said. The idea though is we have some things that they don't on the service side that are otherwise hard to execute commodities, that when you bundle them together is a powerful statement.
Yeah.
All right.
I think
I'm gonna transition us. We
No,
gotta get
we're
off.
not
Yeah.
Oh, we gotta get off of this. I wanna talk about dump fees.
Yeah. Let's talk about
I want to talk about the Stewart, the term Stewart family. I think that's important. You never hear the Wells Fargo family or the Chase family,
Yeah.
but here's the Stewart family. We're bringing them into the Stewart family. I think
You
that's
have
important.
the TMC family.
I know, I'm just saying the family, that term is, just politically correct these days rather than the Stewart hierarchy or the Stewart
Yeah.
machine. All right, I'll pipe down.
All right, all right. We actually, I want to talk about like the things we came here for. Can I get us back on track?
Take it away.
Okay, all right. Well, before we jumped online, and you started to tell us about kind of the big points in the conference and about junk fees and how Mark Jones really had a lot of comments on that. TMC actually took a group of our lenders to DC just recently within the last couple of weeks, and we had an opportunity to actually sit down with the CFPB and talk about their definition of junk fees, because what's being missed is, yes, they're defining, they're grouping in credit, they're grouping in appraisal, they're grouping in some parts of the conversation, even title, but they're, the White House's definition of a junk fee actually is a fee that's not clearly disclosed up front, right? So there's a timing issue and a clarity and transparency issue with it that we're missing, because all of those things, not only are they required for us to produce really good loans, right? We can't sell those to Fannie and Freddie without these core things. We can't produce a qualified mortgage without these core things, right? We are kind of, I don't know, that we're pulling these things into a bucket called junk fees, which are traditionally left for things that are not transparently disclosed. And all of these things, I mean, the whole TRID process that we went through, umpteen years ago causes us to have to disclose those things up front, right? So these things are obviously clearly disclosed, or obviously, required for the process. I do think there is a point of contention that I think CFPB has to come out with a statement on. When we were there with them, what they shared with us is there is confusion with consumers on all the different types of fees that are related to the process, and their foundation of why these things are being lumped in is because they're being called different things throughout the process. And some of that, is state regulatory requirements, right? Lenders have to comply with the state, making sure that it's, called one thing in one state and something else in another state. And so, that was our feedback to them. Look, we can only comply with the requirements that we're given. And when you have one requirement federally and one requirement at the state level, it causes all sorts of confusion. But I want to dig into, I just got off on like a complete rant and soapbox for a minute, so bear with me. But I think I want to dig into a little bit more around the portion of the CFPB conversation around the title waiver pilot. For those that aren't aware about this, TJ, can you explain what that is to everybody?
Yeah, so long story short, probably around last year, maybe a little before that, Fannie Mae was proposing that they amend or propose a pilot with the idea of amending their guidelines to accept certain transactions where title insurance would not be a requirement of loan delivery. So the idea is this idea of title acceptance. And initially they went down the path with a national underwriter called DOMA, who have a title engine that's more of a they call it predictive analytics. I could go into detail about how it actually works or doesn't work, and what it covers and doesn't. But the idea was there'd be a data check on ownership and a waterfall of the risk, and some subset of files would not require a title search or any curative work and could be delivered to Fannie. There would not and will not be any relief from reps and warrants around the security or enforceability of the mortgage or anything around title, just that you did not need to have a title policy to deliver the loan.
Right. So I know you guys have been looking at, some kind of innovative approaches to title, particularly because there are some there's some discussions around alternatives, right? There's this title waiver pilot. There's been, proposals and comments made, from a policy perspective that maybe refinances would not require a title policy. There's also a borrower title policy, sorry. And then there's also the option that's been around for a little while about attorney opinion letters. And so I want us to dig into the difference in each one of those things and what the risk in each one of those things is for lenders, and then maybe what the reward is. And in some of those cases, that lenders may be able to take advantage of to lower the cost of origination for their customers going through the process too.
Sure. So let me talk about one thing that's a little bit of a misnomer. Title insurance in and of itself, the word insurance is distracting. Title insurance is a manufacturing process. And I think that's important to understand. At the end of it, you get a good housekeeping seal of approval in the form of a policy that says the manufacturing process went the right way. And the result of that manufacturing process is a change in ownership of the property with a mortgage or finance activity, or it's a new mortgage that's enforceable and in place that everyone's signed who needs to sign, et cetera, et cetera. And another part of that manufacturing process that I think is not recognized enough is that title insurance underwriters, agents, et cetera, we do what I would call curative work of the public record. So there's roughly 4.5 million documents recorded every year nationwide, and those records are open for recordation. It's kind of an open source of truth where anyone can walk in and put anything of the public record. And it's not the registries of deeds responsibility to curate those records. Ultimately, that comes in the form of what we do transactionally. So we're validating that that it was recorded on the right place, the right person signed, that lien is applicable to that property. We also signify what those documents mean in relation to ownership. So an HOA lien in a state may be, okay, we got to figure that out. An HOA lien in like Nevada, that's a super priority lien. That's an entirely different story. So how do you know what that means? Well, we go and write the rules and kind of help that. So when you think about part of the conversation we've had with the CFPB, particularly around refi and lenders policies, their opinion is, well, that's something that only protects or helps the lender. Why should a borrower have to pay for that? That should be bundled or a lender cost. Well, the idea is that the policy is only the output of a manufacturing process, and the public good of curating the record, ensuring that nothing has come in or intervening liens or change of ownership, or I put in a trust or I got divorced or something else happened. That's something that we kind of do as we go along. And part of the benefit to a borrower who does refinance is you get a second set of eyes on the previous transaction. So if something had gone wrong, we're able to cure it and fix it at that point. And so when they go to sell, there's no issues, right? It's preventative medicine. And at the end of it, you get a title policy. So the title policy is the evidence of the work and not actually the final product itself. It's the process. So I always want to clarify that, because when you hear about AOLs, when you hear about waivers or other things, you're kind of pulling on the thread of that manufacturing process, or you're removing portions of it, which lead to, my Bank for America roots are showing we do UCRAs, unintended consequence risk assessments, not to be confused with okra, the delicious vegetable that you fry and put in ranch. And so you have this consequence of, well, what do I do if I remove a title policy from the conversation? So here's a great example, the state of Florida, which people tend to target because it is a promulgated rate state. Florida is actually an attorney state. There's a case from the late 60s, early 70s that said, hey, title insurance agents and underwriters can perform closing services as long as they're ancillary to the issuance of a policy. So you remove the title policy or go with an AOL or a waiver, you're now in the warm arms of closing attorneys in Florida who will charge nearly double what is common today from a settlement perspective. So my commentary always is, when you're looking at AOLs or alternative products, let's be really, really thoughtful about the path that we're going down. Are we breaking something from a risk perspective? So for AOLs in particular, and I actually have a history with the AOL and the E&O wrapper product, and I have friends that help design it, and others who have helped support and find carriers in the market. I think there's use cases for it, but it's very, very small use cases. It's states like Texas Florida, Pennsylvania that have a rate structure that doesn't have what we call the centralized refinance rate. So we call them bucket rates as a euphemism in the title world, where your policies under $250,000 is a flat fee. It's usually under $400 for your average loan. You're out the door on closing and the policy for under $1,000, which is I think pretty attractive. And when you look at the AOL plus the closing fee, there's maybe a $50 or $100 difference between that and bucket rates. And so you at that point are saying, hey, does that $50 or $100, is that a difference maker for my competitiveness? And what am I losing maybe from a risk perspective in the policy? So in bucket rate states, you kind of go, eh. And when you get to states like Pennsylvania, Texas, or Florida that have a different rate structure, you go, maybe there's a use case there. Maybe there's a place for it. But then you go, okay, in Florida, I now have attorneys closing transactions. In Texas, I'm now outside of the regulatory rubric of the TDI in Texas. What does that do to me? In Pennsylvania, your closing fee and your title fee are all inclusive in one premium. And so now you're in an unregulated state where I don't know what those escrow fees are, and there's no state regulation. So there's definitely a cost savings, but we're not entirely sure what the consequences are. And we don't know what happens in Florida if a title agent closes a loan in reliance on an attorney opinion letter, as has been done for a large wholesale lender. We don't know what the courts will do from an enforceability standpoint. So in the state of South Carolina, where I'm licensed as an attorney, those loans are unenforceable. We don't know what the consequences are yet if a loan is closed that is essentially the unauthorized practice of law. So I do think the product has a use case, but I think we have to really chew down as an industry in partnership to find out what those use cases are, where it fits the right way, where it can bring value to borrowers, and where the risk is low so that they can be delivered. That's really, I think, the conversation. I don't think title insurance is the end all be all of every solution. You need to have a lot of clubs in your bag to make it work for everybody. But just be thoughtful about the consequences of choices.
I think lenders right now are really looking for an opportunity to add as much value as they possibly can to customers. And if they can have an opportunity to save them money, it's important to their competitiveness, to your comment earlier.
Yeah.
They choose to go down the road of AOL because they feel like it really is a more competitive product based on the bucket that they're in, or, whatever their situation is. Are there things that lenders can do or should be thinking about to help mitigate any extra risk that they may have in their state?
Yeah, so absolutely. So number one, from a value perspective, owners' policies are the key to unlocking discounts about everywhere in the country, from a reissue or other places. That work that's been done, that's like having the answers to the test and using them on the next test, right? It's a shortcut, and it cuts down a lot of risk, and there's a lot of ways to help a homeowner and coach them. And I think we're talking, the name of the game today is going to be the loans we mint today in the 6s and 7s are tomorrow's refis when we get into the 5s. And hopefully that's we're looking at 2025 with some rate cuts from the Fed. And so the idea is let's educate consumers now as mortgage professionals on things like that, help them manage their house effectively as homeowners. And then when the time comes, go, hey, that documentation I told you to put away, here's a way to look at it. Here's a way to capture that and get that back and get a discount and have it be very favorable. And in most terms, if it's a rate and term refi with not a lot of cash out and you've got that owner's policy, that substitution rate may even beat buckets. It may even beat AOLs. So just that right there of being a partner with the consumer on that part of it. And then I think about the risk landscape. It's really so interesting out there right now. We're trying to see credit is a big source of problems. Insurance is a big source of problems. I really would say, as loan officers, as mortgage professionals, help your consumer shop for insurance. That is a big, tall bar in that PITI. It is unfortunately driving defaults today and negative behaviors in the servicing space. And it does cause payment shocks. So helping them be an advisor, be a consultative partner in those areas. And I think there's opportunities in appraisal. I think there's opportunities in credit to use skinnier products or have savings that you can pass through. So I could go on and on about that because that's a whole other part of our business. But there's opportunity there where I know we've all gotten shocked with the increase of credit and going from a bi merge to a tri merge. You're essentially increasing costs. If you have two borrowers, that's 2 extra credit reports per borrower. It's insane. So be smart about the spending and just keep that documentation handy.
I know we only have 1 more minute, and I normally throw this over to Rob, so I'm going to let him finish. Particularly, I know it's been loud where you're at, Rob, so you've not been able to jump in, but I want to make sure we finish up with any questions you have.
No, you mentioned insurance. I mean, I keep writing about it. Insurance is a huge issue and blows a lot of deals out of the water. And that has, I would say, successful loan officers have incorporated the insurance discussion right away. And as I like to say, you could beat up your capital markets department all you want for another eighth or another quarter in rate or whatever in price. But, saving 25 or 50 bucks a month on a slightly better rate gets more than chewed up with because your insurance is, $3 grand or $6 grand or 20 grand a year. And so it's the insurance, if you can get insurance in many areas, it's a huge deal. And there's a lot of finger pointing going on, unfortunately, and everyone's saying, well, it's not our fault, it's not our fault. And here in Hawaii, I'm going to leave this call to go listen in on the insurance panel. But yeah, regardless of where I go, insurance has become a whole another issue. And the CFPB is sitting there saying, well, that's not our deal. We can't regulate insurance costs.
Well, they can't, and that's the struggle, right? Insurance is at the state level. And so there is a lot of challenges there. Everybody we talk to in DC, we express the same kind of concern and challenges that we're talking about right now, but they're not the ones that have a lot of direct control. There are some agencies that are looking to come together on some solutions. There's an event I know that HUD's putting on July 18th for this. Don't ask for invites yet. Like, I don't know how they're doing it, but I do know it's coming. So there are some agencies that are trying to come together to solve some of the challenges, but it's a big issue, not just for kind of, climate change challenges all the way down to, servicing portfolios and what we're, talking about here with affording, new homeowners affording a home. But it all obviously trickles down into the state insurance offices. So hopefully, we'll see something, but we got to keep talking about it and ensuring that our state senators and congressmen understand, that our agencies and regulators understand how big of a challenge this is if we're going to make a difference. So, all right, we are all up at time. I know we're actually a couple minutes past. I hope this was valuable for everybody. If so, please feel free to subscribe to our YouTube channel and our TMC Connect podcast. TJ, thank you so much for joining us today.
Yes, thank you very much.
Thanks for having me. Appreciate it.
Yep, fantastic discussion. I hope everybody has a fantastic weekend, and we will see you right back here next week.
See y'all.
Aloha.
Aloha.